Why most people outlive their life insurance. Most people don't realize this, but there's a reason why so many people and families are underprotected right now. It's not because they don't care. It's not because they don't value their loved ones. And it's definitely not because they're irresponsible. It's because they bought the wrong type of life insurance and they're statistically guaranteed to outlive it. And when it expires, the insurance company keeps every single dollar. All the payments, all the years, gone. No payout. Let's talk about how this happens and how to make sure it never happens to you. Welcome back to Money Moves Exposed, where we talk about the parts of money that real families need to understand, not the stuff you see in the textbook. Today, we are talking about something that affects almost every single household across America. Not the boring version, not the sales pitch, the truth about life insurance. The stuff nobody explains until it's too late. If you ever wondered whether your life insurance actually protects your family, today is your episode. Part 1. How most people end up underprotected. Here's the uncomfortable truth. Most people buy life insurance the same way they buy a gym membership. They know they need it, they sign up for something cheap, and they assume it'll work when they need it. But life insurance is not a one-size-fits-all. And companies have gotten really good at selling families policies that look extremely affordable up front, but expire long before the family is financially stable. Picture this. You buy a 10, 20-year policy in your 20s. Fast forward, life happens. The kids, mortgage, bills, job changes, growth, setbacks, stress, the whole real life package. And then year 21 hits, and the policy expires quietly. No payout, no protection. You're older now, maybe with some health conditions, and the price skyrockets. That's how good people end up underprotected without even realizing it. Part 2. Why companies love short-term policies. Let me give you the behind-the-scenes version no one outside of the industry talks about. Life insurance companies make the most profit from policies that people outlive. It's literally built into the math. A short-term policy has low monthly price, higher chance you outlive it, a lower chance of payout, and a higher profit for the company. So guess what they push the hardest in all their ads? Short-term, low price. Too good to be true policies people will almost never collect on. Those $9.99 or $19.99 per month offers you see online? Those are promotional loss leaders designed not to pay out. They get your attention now, but they don't protect your family later. Part 3. The theory of decreasing responsibility. Now here's the part that can change your entire perspective. It's called the theory of decreasing responsibility. In your early adult years, your responsibilities are huge. You might have kids, mortgage, debt, no savings, no investments, single income, and high financial pressure. Everything costs. This is when your family needs the most protection. But as you get older, responsibilities decrease. Your kids grow up, the mortgage is paid down, your income increases, you have some investments built up, and your debt drops. Meaning, you should have more coverage early and less coverage later. Most insurance companies aren't going to tell you that. Most families flip this upside down because of bad advice. They get small coverage when their responsibilities are huge and end up with no coverage when they're older. This is the exact opposite of how wealth-building families plan their protection. Part 4. Term versus whole life without the confusion. Let's break down the two types without making your brain hurt. Term insurance covers you for a set number of years. Affordable, gives you a lot of coverage for a little bit of money, and is perfect for families with responsibilities. Now let's talk about whole life. It covers your whole life only as long as you pay. It's very expensive for very little coverage. Builds slow cash value and is often sold as an investment even though it doesn't perform like one. Here's the simple rule that I teach families. You insure with term, you invest with investments. When people mix the two, they get weak insurance policies and a weak investment at the same time. Not because they're dumb, but because the industry trained them to think that way. That moves me on to part 5, the outlive effect. This is the trap. Short-term policies expire. Whole life policies stay, but you're undercovered. Meaning, most people outlive their policy or they die underinsured. Both scenarios leave the family scrambling. This is why the right plan, the one based on actual math and responsibilities, matters. And the good news, with the theory of decreasing responsibility, there's a simple blueprint that works for 90% of households. Part 6, how to know if your family is actually protected. Ask yourself these questions. If something happened to me tomorrow, will my family be okay long term? Do I have enough coverage to replace income, pay debts, raise kids, and finish the mortgage? When does my policy actually expire? How much would it cost me to renew? Do I know exactly what kind of policy I even have? If you're not 100% sure, you're not alone. Most families aren't. That's why so many people are unknowingly walking around with a financial time bomb. But it doesn't have to stay that way. If you want clarity, real clarity, message me. DM me the word plan. I'll walk through your current situation, your current policy, and I'll explain to you what's good, what's dangerous, and what you need to actually protect your family according to the math, not the marketing. You deserve to build wealth with protection, not hope. And your family deserves the peace of mind that comes with knowing the plan actually works. I'll see you in the next episode of Money Moves Exposed.